Good day, fellow value investors. Monthly update on our YouTube Value Investing Educational Quadrant. And let's start this month from the best buys and then go to the sells. On top of everything, there is my research platform, 21-day money-back guarantee, still fixed price forever if you subscribe now, P ratio of 10, fundamental analysis, more than 30 covered stocks, cycles, sectors. That's what I do, free portfolios. You can check everything in the link in the description below. And now we can go to the best buy here on my YouTube quadrant for me, Amsterdam commodities. And you can see here, this is my model research platform portfolio, and that position is at 3.75% of the portfolio. Perhaps I should have been a little bit bolder when the stock price was lower, but I might still add these prices because the fundamentals are really great. 5.5% yield, P ratio of 10. It is an essential business, spices, seeds, organic, tea, food solutions. They have nailed the previous strategic objectives with 8% EPS growth over the last 10 years. If they keep on doing that, we'll have a €2 to something dividend, which is a yield close to 10% down the road, and that will likely not be like that. So you have a dividend over the years plus upside from that adjustment of market. And such is a business where I can still find value in these markets. Of course, it's a small business, but I've been following for 10 years now, so I know it pretty well. Small niches, small pockets is still where you can find value, and adding here and there these good value things can compound your portfolio through dividends that will be there no matter what happens with the market, and perhaps over the long term even capital appreciation. Next, we have my Norwegian oil producers. Aker is doing okay, a little bit higher as things are improving on the outlook there. Oil isn't improving that much, maybe a little bit, but stable. However, they will pay their, I don't know which is the correct dividend, US NOK 8-9% dividend. Very low cost production, oil, Norway, nothing wrong. It will keep on doing, you can reinvest elsewhere the dividends. It's interesting for portfolio exposure. Equinor, now the dividend yield is smaller, the market capitalization in the business is much bigger. However, this is an oil company now going into offshore wind, things like that, which they are doing, in my opinion, just for cosmetics. There is no equal return on invested capital as with drilling Norwegian oil, so they have the money, they're paying a good dividend, pension funds, they want it sustainable. So that's why I prefer Aker, and so we're going to eliminate Equinor from the quadrant. We'll stick to Aker and that's it. The next one, I have discussed BlackRock and put it in the quadrant as an example. Here is the video that I made just 2 weeks ago. However, when it comes to BlackRock, yes, all else equal, growth and everything, the bubble continuing, BlackRock stock will be a 2x going forward the next 3-4 years. And it will just keep on compounding as the ETFs, everything compounds. However, this is a LinkedIn post I made, but everything is so expensive. If this bubble reverts, then BlackRock will also go down, and there is no margin of safety there. So for me, it is too risky, and therefore I'll also remove it from the quadrant. The next business is GreenBrick Partners. It is a little bit weakening on some weaker results and land prices going on in Dallas and Atlanta, I think. All the links to the videos, the full analysis of the mentioned stocks can be found in the description below. Let's look a little bit just at the results here. Things are not growing as before, just a little bit subdued, 4.6% revenue down, still making money, still investing, all well, However, you can see here negative earnings per share, 10% down, and that is normal with housing, just a little bit of the trend reverting, and everything changes. However, it's not a bad business. They keep on buying these land plots across Dallas. Even if Dallas traded Luca, we'll see whether the housing market will be destroyed because of that. On Atlanta, I don't know much. My wife was there a few years ago. She said it's great. I remember Dominique Wilkins, but that's it. Anyway, this is a land investment opportunity, still at a P ratio of around 10. And then with inflation, with this, the long term, there is protection from that land bank if these communities keep on growing. It looks good, nothing wrong with it, but with land, I expect that real difficult crisis that makes it really a bargain when you are buying land for pennies on the dollar. We are still not yet there where we perhaps were just a few years ago. They are great, they have very great balance sheet, all good, and that's why long term they should do their 10% return. Perhaps I will bring it a little bit more risky here and then still keep it at 10-12% return. Another company that we discussed yesterday is Fiserv, crashing, a value investment, but you need a strategy there, so check the link to the video description below. However, it's interesting. Another company, Stellantis, the stock is down, but this is automotive stocks, the same as internet stocks 99, as AI stocks now. There is no competitive advantage, or airlines. And I've made a video discussing the risk and reward. Of course, it's better now that the price is down 60%. However, there was this great video that I made on the extrapolation bias, because all of you were saying how bad it is now that the stock is down. When the stock was going up, people were saying how good it is. However, it's a car maker, not interesting to me, so I am deleting it. HPQ just made a video, 10% free cash flow yield, buybacks, dividends, great position on the PC market. Printing, yes, going down, but has been going down for a decade and it's still there, still profitable. It looks okay, it looks good, perhaps some recession could hit it even higher, and that is the risk that also differs me from it. Nomad Foods, likely better update next month because earnings are coming in a few days. It is cheap on fundamentals. Again, we have analyzed it just recently, 3 weeks ago in the video, so check it out. And I see now here 5.3% yield. Now we are already 6% yield as the price went down. Next, we have Valaris, stolen from Monish Pabrai, shameless, copying as he says. The P ratio is 10, it was an absolute bargain, and now the market is rewarding that, and the stock doesn't stop going up. Very, very interesting. The prices, the daily rates are going up, they're making more money, higher backlog, so everything good, no issues, and therefore the stock is going up and will likely continue to do so. Now, I missed the train there, maybe next time, but I'm removing it from the Quadrant as now I can't help you much anymore there. Then we have this bunch of 7 to 10%, let's say a little bit riskier businesses, so let's just discuss. We analyzed Comcast recently, simple for me, it's a no-go, too much debt. Domino's Pizza, that is an interesting one, especially the London stock. They are offering now 10% free cash flow yield, perhaps even higher growth if acquisition good, but that is also the risk. Another Einhorn stock, CNH Industrial, if you wait for that cycle to revert from food, it will likely lead you to 10% returns over time as farmers start buying back more of the equipment. Amcor, again, another P ratio of 10, just merged, merger risks there, but also merger upside, dividend 4%, recession might hit because their pricings go lower. However, a very, very interesting business, a little bit high on the debt side, but they'll likely work on that. Now, Canadian stocks, we discussed Canadian National Railway, Canadian Natural Resources, and other Canadian stocks. As I said in these videos, those businesses are a little bit expensive, so I'll remove them from the quadrant and maybe circle back when the time comes. Then we have Occidental Petroleum here. The stock is getting cheaper and cheaper. They have sold Oxychem. Interesting situation there, but this is not Norway. Therefore, same return here as Norwegians, but higher risk because of the higher production costs. I don't yet know where oil will go, but if oil goes to 50, 40, then that will again be a trigger for the next cycle, and then you can buy almost whatever in the industry. Vail Resorts, 7-8%. I'm not sure about it. There is a good dividend yield. Perhaps if you want a ski company, it has something there. It's not easy to build a ski resort. We'll see. Let's see if I put it maybe next time, decide on that. Warrior Met Coal, another Monish Pabrai idea. Coal has been going up. I've seen also my coal-related commodity stock going up in the model portfolio. So as long as that is positive, things are going up. Therefore, okay, already significantly up there. Perhaps I should also remove it from here or bring it to higher risk. Now we have the Dow Inc. company, chemical company, the dividend yield, but is going lower and lower. If you look at the results, negative, down, profits down, losses turning into operating losses per share. They're trying to sell assets to keep the cash flows there. But the best time to buy such a business is when everything looks ugly. Peter Lynch says that you want to see some starting improvements, and even if then the stock price is already higher, it's better to buy it here and ride it to here rather than buy it here and perhaps see it again going down. Big downside still on a recession, and that's why you want to wait for that improvement. The next stock we have is Petrobras, Petroleo Brasileiro. They need higher oil. If not, it is risky, and that is also reflected in the stock price. Another that we discussed recently, ASML, I included it when the stock price was closer to 600. I think I said here it was a good reward and low risk because it was unlikely you'll lose money. That has materialized, so I'll just remove it from the quadrant there. We have Nutrien, mid-cycle on fertilizers, so 6-7%. You want it at 15% for a great value investment buy. Same story there for BHP. This is actually very risky now, so I am bringing it towards the 5% yield here. Amazon, great earnings, growing, but I cannot forget a few years ago when the downside was minimal, the upside was 2x, it's now even 3x from that price when we made this risk and reward video. Next time, if this happens, I might buy it again. Now it is here on the risk and reward. Nothing bad with Amazon. Great business, great growth, 14% over a year. Everything good, operating income growing, free cash flow, however, down on the huge investments. And we yet don't know what will that investment bring, because if we look at the profitability of this cloud and everything, yes, it's growing, but the profits not that fast, and the competition there is fierce. Then we have Google, stock price is going up, thus for me it's getting riskier and riskier. However, I remember discussing how it might even get to 500 on a little bit of exuberance AI and being destroyed in the comments how that is crazy when it was 170 here. But we see we are now getting closer and closer to that. But that also means it's highly risky, so nothing for me. The dividend equity ETF, when I look at all these businesses like these high dividend payers are related to the economy, I might even increase the risk of this dividend ETF because with a recession, these dividends go down and therefore the yield cannot be above your dividend over time, perhaps even a little bit riskier. So, not something I would consider for my portfolio. Next one, S&P 500, Shiller ratio, extreme valuations, extremely risky. Everything indicates this is a bubble. I hope it doesn't burst if you're long the S&P, but it is extremely risky. Plus, if it bursts, if things go bad, the current dividend yield is nothing, and with nothing, you cannot make a lot of money. That's why we discussed Berkshire, the cash position there, so you might want to check that video for Berkshire, which is much better than the S&P 500 if you want to invest in a diversified US business. Now, how does this fit my portfolio? Well, this is my diversified portfolio. I had opened a mid position in ADM at 45 something 50. So now we are already up there going towards a full position in Amsterdam commodities, holding there, Aker medium position, waiting for that oil crash, Mosaic and Nutrien medium positions on that fertilizer. We're getting some dividends, nothing crazy there, and Nomad Foods medium position to see what's going on. What does it mean? So medium position is, let's say, 2-3% of the portfolio where there is still a risk, thus I might make another buy. A full position is 5-6% of the portfolio where I already expect a 10% or higher return over time, and the portfolio is doing 15% over the last year and something since inception. 22 positions all covered on my research platform. So this is now a little bit cleaned. Next month, we'll add new businesses over the month, we'll clean something, and I hope you enjoyed this video. If you want to see the premium version, you can check it on my research platform. Thanks for watching, I'll see you in the next video.